Good morning and welcome to the i3 webinar on navigating the new risk paradigm, co-hosted with Northern Trust Asset Management. My name is Wouter Klein and I'm the Director of Content at the Investment Innovation Institute. So today we will be discussing how to prepare global equity portfolios for the current environment of increased and more extreme volatility. And this environment is likely here to stay, or as some would say it's the new normal. So how do we navigate this environment? So this webinar is partly based on Northern Trust Asset Management risk report, which dissects equity portfolio and analyzes the type of risk investors are exposed to, and whether they're intended or unintended, or rather uncompensated risks. So we will look at the impact of over-diversification and portfolio redundancy, or the cancellation effect. And to do that, we have a special speaker here today. So our speaker today is Michael Hunstead, who is the Deputy Chief Investment Officer and Chief Investment Officer of Global Equities for Northern Trust Asset Management. He's a member of the Asset Management Executive Group and has oversight over all equity portfolio management, research, and trading, including quantitative, index, and tax advantage strategies. Now, we would like to keep this webinar as interactive as possible, so please feel free to send us plenty of questions through the question box, and we'll try to cover as many of them as possible. And as a disclosure, we have to say that this webinar is for educational purposes only. It does not constitute financial advice. It's intended for institutional and wholesale investors over. So we've got a short presentation and then we dive into some questions. And so Michael will have a few slides to start off with. So Michael, over to you.
Great. Thanks, Wouter. Great to be back. When I talk to my clients, and I have the distinct privilege of seeing clients all over the world, virtually all of them are concerned about this concept of de-risking, whatever that might mean, and we'll dissect what that might mean in a second here. But it's clear that the risk environment that we find ourselves in today is something a little bit different than what we have seen in the past. What I'll argue today is that there are microstructure issues at work in equity markets and in fixed income, although we're not going to talk about it today, that are causing the volatility backdrop to look very different today than it did 1 decade ago, 2 decades ago, even just a few years ago. So it's not your garden variety kind of higher risk environment. There's something different here. Now, the key takeaway is that we have to be more precise in the risk management of our portfolios, but we also have to be more precise in how we select managers and how we analyze managers in their component risks. And we'll describe how that what that means going forward. Okay, so let's advance a slide. First slide is just the agenda, so we'll cover that. When we think about new age of volatility, I said it's not your garden variety kind of higher volatility environment. If we move to the next slide, you get one depiction of what I mean by that. So what I've done here is I have graphed the 1-day movement in the VIX index. If you're familiar with the VIX index, it's the index of implied equity option volatility, often called the index of fear. And I have highlighted as a volatility shock any one single day in which the VIX index went up 5 points or more. So the roughly vertical line, maybe it's a little hard to see on the left-hand side, the gray shaded area, that's the pre-financial crisis era. Everything in green or bluish on the right-hand side is post-financial crisis. The point is that if you look at these volatility shocks, and this graphs again that 1-day movement, both the frequency and the severity of volatility shocks are increasing, not just a little, but a lot. We have gone from 5 volatility shocks in the 7 years prior to the global financial crisis, 69 volatility shocks since then, 12 of which have occurred in the last 12 months alone. On average, when those volatility shocks occur, they are 50% greater. So what does this mean? This means that we have not only more volatility shocks tend to be accompanied with a precipitous drawdown in the equity markets. This means there is more tail risk in equity portfolios than there has been in the past. We won't talk about it today. How do we typically deal with tail risk? We deal with tail risk in equities, usually by allocating away into fixed income as our safe asset, given that correlations are very high in fixed income and the fact that fixed income volatility on its own is relatively elevated exacerbates this problem. But I'm going to put that to the side for now. So a higher frequency of volatility shocks, more frequent and more severe tail events in our portfolio. Now, another way of looking at this, if you go to the next slide, is thinking about asymmetric volatility. Same concept, but a different metric. So what I've done is by decade, I've basically cut the market into two pieces. What is the volatility of the market when the market's going up versus the volatility of the market when the market is going down? And that last row, I take the ratio of those two. So down versus up volatility, you can see that between 1990 and 2000, that ratio is just about 1.2. The next decade jumped to almost 1.5. In the last decade, it's about 1.8 and growing from there. The last few years have been elevated even further. This means that there's more volatility, more severe volatility on the downside than there is on the upside, a significant asymmetric risk pattern developed in equity markets. Now, this is specific to the US, but if we cut it by other geographies, same idea. Whether it's regional or at a country level, we tend to see this asymmetric risk profile at play. Now, it's not just the aggregate index that has this sort of unique behavior. If you go to the components of an index as well, and on the next slide, we show the dispersion in sectors. And over the last decade, you can see that there's a general trend up and to the right. What this means, dispersion is the sort of the difference between the performance of the top performing sector and the bottom performing sector. And whether it's a US benchmark like the Russell 1000 or an MSCI global benchmark like the MSCI World, we tend to see this heightened level of dispersion across sectors as well. I can make the same chart for countries, for regions, so on and so forth. There is a lot more going on under the hood of a traditional equity benchmark than just the surface level volatility. All of the components themselves have more volatility, whether it's systematic factors, sectors, countries, regions, currencies. Everything is at a churn, a wild churn underneath the hood. And that makes not only the level of risk very important, but how you source your active risk very, very important. We're going to talk about that here in a second. All right, so why is this going on? Probably the most interesting part of the presentation in my mind. I get asked this question a lot. If you go to the next slide, there are at least 2 or 3 really credible reasons, microstructure issues, microstructure reasons why we're seeing this increased level of volatility. And on the next slide, I'll give you the sort of the most probable, in my mind, reason why we're seeing this very different behavior of equity markets. Now, we've talked a lot as an industry over the years about the institutional shift from active to passive investing. And on this chart, if you look at the gray line, you can see the percentage of passive market share for institutional investors went from about 5% in 2000. It's now more than 50%. So in 2000, 95% of assets were actively managed, meaning there were analysts worrying about valuation multiples, profitability, cash flows. Over the years, that has trended away. Now less than half of these assets are actively managed, which means that there's a huge portion of institutional assets sitting on the sidelines, not participating in price discovery. Well, if institutional investors are not participating in price discovery, who is? Well, it tends to be a more retail investor. More retail investors tend to have more animal spirits. They tend to have more emotion. As a result, they tend to move the market more for a smaller dollar value of flow. We call this inelasticity, and that's graphed in the blue line. Unambiguously, equity markets worldwide have become more inelastic over the last couple of decades. So again, a smaller dollar amount of flow has a larger impact on the overall price of the market. That manifests in these higher frequency and severity of volatility shocks. Markets more inelastic in general. You don't have to take my word for it. On the next slide, what we graph is the nonlinear correlation between ETF flows, the preferred vehicle for a retail kind of investor, and the number of volatility events that occur in that period. So you can measure this a whole bunch of different ways, but it's pretty clear that this shift away from active on institutional and the rise of ETF investing in retail has precipitated some of these volatility issues. Now, another really good explanation on the next slide is the growing frequency of volatility selling that we see in markets around the world. So basically, if you're selling insurance into an equity market, everything works really, really well until the market goes down and you have to cover. And when you have to cover, you tend to exacerbate that drawdown. Similar, in a related way to algorithmic trading, I was a former algorithmic trader myself. I programmed in off switches to my algos. So equity markets go down, I gotta protect myself. All the liquidity that I'm providing to the market goes away because I programmed it to go away at exactly the wrong time. So markets go down, liquidity starts to peel away. Well, what happens? Markets go down even more. Again, precipitating these higher frequency of tail events. I'm not gonna talk about zero-dated options, but this is clearly a culprit as well, working in much the same way. There's just much more of a mechanism by which we can move the market with a smaller dollar of flow overall. I think that's the key message here. So something has materially changed in equity markets around the world that have made that risk profile quite different. All right, so are we prepared to take action against this heightened level of volatility? Do we understand the volatility in our portfolio? How do we deal with it? Are we good at that? These are the questions that we attempt to answer in a piece of research that we do periodically called the risk report. If we can flip to the next slide. Basically, the risk report, go ahead, one more slide. Risk report is about real life client portfolios. So we have offered our clients over the years a service we call a portfolio factor analysis, which basically is taking their holdings and cutting them into all the relevant risks that we may be concerned with. And the number is now in the hundreds. So there's currency risk, country risk, idiosyncratic risk, compensated factors, uncompensated factors, the list goes on and on and on. With today's off-the-shelf risk models, and we're using BARA for this kind of analysis, we can decompose into a portfolio into hundreds of different risks. Now, when we do that, I think the key innovation over the last, say, 10 years or so is the realization that some of these risks are compensated, meaning they come associated with higher return. And if you go back to your Finance 101 class, they told you that if you want to earn more return, you have to take more risk. Or the corollary, if you take more risk, you necessarily earn more return. Well, neither of those are technically true, or even really true in any material sense. What we know now is that within any asset market, some risks are compensated, meaning they do come associated with higher returns, but many risks, if not most risks, are not. And that's the innovation over the last couple of decade or so, and we'll return to that in a second here. So if you take that as your starting point, some risks are compensated, other risks are uncompensated. When you think about portfolio diversification, ideally what you would want to do is diversify away those risks that are uncompensated and keep those that are compensated. So two really, really basic ideas, but in practice, things go all kinds of haywire. And what we found in our history of doing these portfolio factor analyses, and we've done more than 1,000 of them for institutional clients all over the world over the last decade, that there are 6 really common themes that keep popping up over and over and over again. And I want to highlight just a few of them briefly. They're all spelled out in our risk report research. But number one, probably the most egregious, not necessarily, but probably, is that when we look at these institutional portfolios, these are superannuation funds, sovereign wealth funds, very, very large public pension funds. You would think that these are the most sophisticated investors on earth, and they are in many, many ways. But what we found is that, you can see it on the left-hand side, When we look at their risk profile, these portfolios tended to have about twice as much uncompensated risk as they did compensated risk. Why on earth could that be the case? Well, it tends to be the case because we don't necessarily always think about the individual composition of our risks when we put our portfolios together. I'll give you an example of this. A lot of clients right now looking toward more defensive equity, lower volatility strategies. All right, so they want lower risk profile. In a lot of strategies, they get that by overweighting the defensive sectors, real estate, consumer staples, utilities, only to find that not only do we have these sector risks, but we have potentially some unintended macroeconomic exposures as well. So these are the bond proxy sectors. They tend to have a lot of interest rate sensitivity associated with them. Interest rate sensitivity is an uncompensated risk. Sector risks tend to be uncompensated risks. You want this lower volatility profile, but you may be inadvertently exposing yourself to a whole host of unintended bets that are not compensated over the long term. So this one example, there can be many, many others. Twice as much uncompensated risks in portfolios as compensated. Doesn't matter how sophisticated you are, how sophisticated you might think these asset owners are, they tend to have this profile, and this has been consistent over the last 2 decades. All right, point 2. Again, if you think about diversification in an ideal way, that you want to diversify away those risks that are uncompensated and keep the stuff that's good, keep the stuff that is compensated. In reality, the reverse happens. We tend to be a little bit overzealous in how we think about diversification. We can think about diversification in many ways. We can think about diversification in terms of the active share, that we have individual stock bets that across managers are providing some kind of diffusion of their risk. We can think about diversification at a sector, or region, or country level. We can think about diversification at a systematic factor level, like growth versus value. All of these cases, we have seen instances where you tend to throw the baby out with the bathwater. And I'll give you a great example of this. When we did this study, there were 3 instances, and again, these are very, very sophisticated investors, 3 instances where portfolios had both a Russell 1000 growth mandate and a Russell 1000 value mandate at benchmark weight. Well, you may not necessarily be familiar with the Russell indices, but when you put the Russell 1000 growth and the Russell 1000 value together at benchmark weight, you get exactly the Russell 1000 core index. You get no growth exposure, you get no value exposure. This is an example of over diversification or cancellation, whatever you want to call it, at play. So you thought you were getting growth and value exposure. In 3 instances, we see that there is in fact nothing. Now, it's not necessarily that extreme in every portfolio, but we have many, many instances where we inadvertently diversify away the good things and keep a lot of the bad things. And on the upper right-hand side, hidden risks in the portfolio tend to be really the rule rather than the exception. So if you're a value investor, for example, depending on where you're at in the macroeconomic cycle, you can easily have an overweight to energy or financials, depending on where commodity prices are, where interest rates are. 2 classics. Well, again, when you think about the embedded risks, the macroeconomic risks in those sectors, you have interest rate sensitivity, you have commodity price sensitivity, you may have a valuation sensitivity as well. Do you realize that you have these macroeconomic exposures? Low carbon portfolios is another great example of this. Clearly, and it makes a lot of sense, there is a commodity price implication, commodity price risk associated with low carbon portfolios. We need to be cognizant of that as well. So I'm just going to touch on 3 of them. There are 3 more that are detailed in the risk report, all very, very interesting, but in the interest of time, I'll skip over them. Maybe go to the next slide. I'm just going to kind of close on this. I just want to drive this home. When we think about risks in our portfolio, We think about them in their various component parts. And if there is a message today from the presentation, is that when we look at this new heightened risk environment that we're in, heightened volatility environment, we cannot be complacent about how our risk is comprised. So if I take the equity market, I can decompose the equity market into all these various kinds of risks. Now, as I alluded to earlier, some of these risks are compensated. Those ones that are highlighted with a color tend to be compensated, so quality and value and size, momentum, etc. Those that are shaded gray, light gray, tend to be uncompensated. So we have to be very, very precise about our risk management. Going forward, the equity market return will likely be less than it has been in the last decade. In the last decade, we can afford, again, to be complacent, largely complacent about risk. Going forward, we need to be much, much more precise, not in just how we measure risk, but also in how our managers are utilizing risk to generate returns. So I'll leave it at that. I know we have several questions that have come in, but the key message is be precise. The actions of the past in terms of risk management, not necessarily applicable to the future. We have more data, we have better tools at our disposal. We really need to use them when we think about risk mitigation.
Thank you very much, Michael. That was very interesting. So yeah, please send us plenty of questions through the question box. That's just on your right in the gray area where you can send some questions in. Michael, I might just start off with one. I thought it was quite interesting that finding that you have found twice as many unintended risks as there are intended risks. How do you interpret that? Is that people are unaware of these risks in their portfolio, or is it just very complicated to avoid any unintended risks?
I think it's because they typically rely on their managers to deal with the granularity of risk. And that's not necessarily always a good thing. So I'll give you another example. If you are an investor in a high yield or high income strategies, when you build a high dividend yield strategy, if you're going for the highest yields in the market, you tend to be concentrated in certain sectors, you tend to be concentrated in certain regions. And lo and behold, that high income portfolio of what are in principle relatively safe stocks, and that they have these stable cash flows, which allows them to pay this higher yield, have big sector bets, big country bets associated with them. And at times, those bets can really go against them. And we have seen that actually play out. So I think people's perceptions, asset owners' perceptions of risk versus what is the reality in their portfolio can be two very, very different things. And what I found is that when we decompose these portfolios into their component parts, there's often a lot of surprise as to which risks there are actually being taken.
Yep. There's a question here that comes through from the audience. Is this structural or more temporary in nature given a market composition?
I believe this is structural, and it took 20 years for the institutional shift from active to passive. It's going to take 20 years for it to go back, if it does go back at all. Not only that, we do have, as we pointed out, more volatility selling, more zero-dated options. There's a lot of reason why this heightened inelasticity should persist, and will probably persist for quite some time.
Yeah, and to what degree do you think it is related that portfolios have become more complicated over time, and so perhaps it's not as easy to untangle all the risks from each other?
So there's two pieces to that. Both of them are excellent questions. The first is they are more complicated. There's no doubt about that. But all the more reason we have to be cognizant of the risks we're taking. So I mentioned low carbon. ESG investing overall means that you're being exposed to a different set of risks. If you have a net zero or Paris-aligned benchmark, there are embedded sector risks, there are embedded valuation multiple risks today in that kind of investing. We need to be very, very cognizant of those sorts of things as we construct our portfolios. So the more complicated your objectives and the constraints that you place in the portfolio, I believe the more vigilant you really do need to be in terms of measuring risk. The second piece of that is, one of the, just going back to, Finance 101, one of the assumptions of the capital asset pricing model is investors are homogeneous up to their covariance with the market, and securities are homogeneous up to their covariance with the market. Neither of those things are true these days. Everybody has a different set of objectives. Everybody has a different set of constraints. If that is the case, that tends to precipitate these anomalies that we see, like the value anomaly, like the momentum anomaly, like the low risk anomaly. People ask me all the time, are these compensated risks going to be arbitraged away? And I often think that far from being arbitraged away, they may actually be accentuated as we go forward, because we're becoming much more different as time goes by rather than more similar.
Yeah. Now, the risk report touches as well a little bit on market timing and factor timing. And there is here a question in the app around, have you seen examples of successful market timing?
Yes, but not on average, and I'll state that. So if you're into sort of the research side of things, I'll recommend a phenomenal paper by the authors Goyal and Wahal that looked at different plan sponsors and the hiring and firing behavior of plan sponsors over, I believe it was a 30-year period, and fascinating results. So probably not a surprise, but they looked at the 3-year performance of managers that were hired, and relative to their peers, they were shooting the lights out. So clearly you hire managers based off of their track record, right? Prior to being hired, they're doing really, really well. But really interesting is that once those managers were actually hired and placed into the portfolio, they tended to underperform that track record significantly. So you buy them essentially at that peak on average, you hold them through that trough on average, and then the kicker is they also measured what the performance is after those managers were fired from the portfolio, and they went right back up again. So it's almost this continual wave of, call it wealth destruction from return chasing behavior. Now, we found a very similar pattern in the risk report, that when times were good and equity markets were doing well from an absolute as well as an active perspective, people were putting risk on to try to take advantage of that, only to ride that into the trough. So on average, there is a lot of return chasing behavior. That doesn't mean that every portfolio had this, but it's a strong concern that we see, and it's definitely has been a negative on performance on average.
Yeah. Another question is, given retail investors appear to be driving price discovery, would the momentum factor be expected to be the most compensated from a risk perspective?
There's a very good reason that will be true. So if momentum, just as a reminder, tends to be kind of an over extrapolation of information, where value on the other side, at least one explanation is momentum tends to extrapolate positive information or positive news, value tends to extrapolate negative news. And you're seeing that in a sense. So momentum has been very, very potent recently, but it has also meant that those, call it value stocks that have had more negative news associated with them, there's been a big spread between the performance of the higher momentum and higher value. So going forward, do I expect momentum to have a lot of potency because of that retail sentiment? Absolutely, I do. You have to be careful about the risk of momentum in and of itself and manage that intelligently. But I think that's one of the byproducts of this inelasticity, is that we're going to see some factors like momentum become more potent through time. Now, that's not to count out value. I still think that over the longer term, value can have a very successful run. Over the very short term, momentum can be quite potent.
Yeah, there's here a question about how you define risks. It says, you seem to be defining risk as an equity portfolio risk relative to the equity benchmark. Would the assessment be different if you were considering risk from the perspective of a total diversified portfolio?
Great question. So yes, I did. So in the latter part of the presentation, I took an active view, an active risk view. But if you look at the individual components, even in an absolute sense, those are risky as well, as I pointed out earlier in the presentation. So sectors have more volatility, countries have more volatility, currencies have more volatility. What this tends to do is increase that tail risk at an absolute level as well. Now, the level of the VIX index hasn't changed much over the last decade or so, but when things go wrong, they tend to go wrong very quickly. Now, why hasn't it changed much? Is a really good question. There's two answers to this. One is that the component parts are independent, and therefore they're providing some diversification. That's a reasonable explanation. I think a better explanation, at least over the last couple of years, is that you've almost have two equity markets at work. You have technology stocks and everything else. And they are very low correlation between those two pieces. They clearly both have some beta to them, but they're relatively low correlation in providing a ballast to each other. This has driven the absolute level of the volatility, the implied volatility, to be fairly consistent through time, but those shocks to be very, very severe. So when they do occur, even in an absolute sense, they can be very, very significant.
Yeah, we spoke a little bit about the rise in popularity of the total portfolio approach, and I was wondering, in your opinion, does that help with sort of identifying these unintended risks or the doubling up on risks? Because you probably have a little bit more of a sense of the different exposures across asset classes, and do you think that that might avoid doubling up on some of these risks?
Potentially, but it can also point out where you're doubling down. So it could very well be the case that your active risk profile in equities is similar to your active risk profile in bonds. So if I've got a good credit, this could be that the equity is good as well, and I'm overweighting both of them. Therefore, I have a similar kind of risk in my portfolio. Now, it is important if you can take that total portfolio view. I do think that it has a lot of information content to it. The challenge is this, is that most portfolios that I see manage against an equity benchmark in their equity bucket and a fixed income benchmark in their fixed income bucket, not a total portfolio benchmark. So if you're worried about the performance of any component relative to its policy benchmark, then it becomes important to look exclusively in that asset class. So both views are great. Ultimately, in principle, the higher the level, the better. But at the end of the day, most of us, our performance is measured against that individual asset class benchmark.
Yeah, fair enough. There's a question here about passive investing. So you indicated that passive is now more than 50% of the market. How much more can this trend go before the market becomes dysfunctional?
Another really, really good question. So there's been some research put out on this. I would say that we're already starting to interfere with price discovery, which makes this an issue. Clearly, as I pointed out, we're influencing the risk dynamic. Now, what does this mean? How far can we push it? Well, in principle, we can push it all the way. If in theory, institutions invested 100% in passive, it's just then the retail market and the volatility generated by the retail market that's going to not only set prices, but create these active and absolute volatility profiles. So what does that look like? Well, we can look to other countries as an example. China, for example, has a much higher retail presence in the market than many other countries. And you can see the volatility profile of China looks similar to where we're going in developed markets as well. So I think that is a litmus test or kind of a roadmap. Now, it's going to take us, another decade or two to get there at this current trend rate. I hope it reverses at least a little bit or stabilizes before we get there, but I think that's a reasonable example of where we might end up in terms of the volatility of each of the components.
Yep. Yeah, we've got a very polite question here because it starts off with, thanks, Michael, for an excellent presentation. With regards to the last slide on deeper dive into risks, are there a select few that actually drive most of the risk return of a portfolio? And also thinking about the correlation of some of these smaller risk factors. So would it be better to focus on a select few risk factors instead?
I'll answer the second part first. Yes, in general, what we have seen is that many institutional asset owners, if they are thinking about an active risk profile to their portfolio, tend to focus on factors like quality and value, momentum, volatility, and size to some extent, but the main four, quality, value, low volatility, momentum, are the classic combination, and that's worldwide. Asset owners are all over the world taking advantage of those factors. Are they the bulk of the driver of active return? They are indeed. And several other great papers that are out there, I'll quote one, Mark Carhart, now this is from the 1990s, looked over a 30-year period at active managers and where they actually sourced their excess returns. And for those managers that actually outperformed their benchmarks, more than 100% of their performance came from the factors that I just outlined. Security selection, on average, was a drag, so a negative number. That doesn't mean that there were not managers that didn't have good stock picks. It just means that on average, that was really, really hard to find. So yes, those four factors in particular, size included as a fifth, tend to drive most of the excess return of equity markets over the long term.
Yeah. How are you looking at risks from failing to meet climate or sustainability goals?
And it's growing. I would say that one of the most interesting dynamics in the risk dimension is that, you know, if you look at risks through time and how they have evolved, decarbonization and ESG risks have shot up there in terms of their efficacy. Let's put aside the return consideration and just focus on the risk consideration. There's no question that they are real, very, very real risks in the portfolio. So we as portfolio managers, whether we're decarbonizing our portfolio or not, have to be very cognizant of the embedded risks that we're taking one way or the other. And I think that's the great innovation, even for those portfolios themselves aren't necessarily climate aware or ESG sensitive, that more and more, call it traditional asset managers, if you want to call them that don't focus on sustainability, have to be cognizant of these risks as well. That is cut and dry. That is very, very clear in the data. Again, we can debate, you know, whether they're positive or negatively compensated, but the risk is there and we have to deal with it. So you add that dimension as well. So now we take country and currency and sector and style factor and all those other risks, and then add to that all these ESG, decarbonization, sustainability components. That becomes even a more complicated problem at the end of the day.
Yeah. There's a question here as well about liquidity. How do you think about the risk from unlisted assets, how it interacts with other liquid asset classes such as equity, bonds, and credit, especially when it is not marked to market in a stressed market?
So this is a classic issue that we have. So when we take our clients' portfolios and analyze them, these unlisted, more illiquid, typically private equity, private credit kind of assets are a little bit more challenging when we think about modeling them from a risk perspective. Now, we can do that in a couple of ways. One is to take a returns-based approach rather than a point in time kind of snapshot of the portfolio. But grossly generalizing here, in some of these assets, you do see some very potent exposures that are similar to, if not redundant to, what you see in your public markets. So you see valuation exposure, you see size exposure, you see leverage exposure, you see quality exposure. So even though they're not marked to market, or they are only marked maybe on a quarterly basis, they are a very, very real risk in your portfolio. Now, we have ways of dealing with that, but I would say that by and large, we cannot count them out. Even though they're not marked, they are real risks over the long run. And that's what we're really concerned about here is how are we managing our portfolio over the long run to meet our ultimate return objectives.
Yeah. Now we hit the 10:40 mark, so we're close to finishing up at this webinar. But perhaps I can sort of ask you one final question. Earlier we said this webinar is based on the risk report that comes out every 2 years. I think we're getting close to the next one. Do you know when the next one is coming out?
So we update every 2 years. It will be the next edition, the third installment will be later this year, probably Q4, if I'm not mistaken. So now that being said, there's a lot of consistency between the first two versions. And I know already, having seen the data, that there will be a lot of consistency in the third installment as well. So for a really, really good preview of what's going to happen in the next edition, you can take a look at what we have in the latest as well.
Excellent. Well, Michael, thank you very much for your presentation today and for answering the questions. It was a fascinating topic.
Great, thanks to be here.